Welcome to Speidel's Federal Tax Minute. I'm your host, Catherine Sedan. This week we're covering changes to charitable contribution deductions made by the One Big Beautiful Bill Act. Sign up for a deep dive into OBBBA tax provisions with Speidel's 2-hour webinar, Understand the New One Big Beautiful Bill Act. You can get details and register at speidel.com under webinars. The OBBBA makes 4 important changes to the tax rules for charitable contributions for individual taxpayers. The bill creates a new deduction for charitable contributions by taxpayers who don't itemize their deductions. It permanently extends the higher contribution base of 60% for charitable contribution itemized deductions. It places a new 0.5% floor on charitable contribution itemized deductions. And it creates a new credit for charitable contributions to certain scholarship-granting organizations. Non-itemizers can claim a charitable contribution deduction of up to $1,000 or $2,000 for married filing joint for cash contributions made to charitable organizations other than IRC Section 509, subsection A3 supporting organizations or donor-advised funds. The deduction is available beginning with the 2026 taxable year. The ability to deduct charitable contributions up to 60% of the taxpayer's contribution base is permanently extended. It had been scheduled to expire at the end of the 2026 tax year and revert to 50%. Beginning with the 2026 tax year, the charitable contribution deduction for individual taxpayers who itemize is only available if all the taxpayer's total contributions exceed 0.5% of the taxpayer's AGI for the taxable year, computed without regard to the charitable contribution deduction. Carryovers of contributions made in the 2026 tax year are subject to the 0.5% floor, but carryovers of contributions made prior to 2026 are not subject to the floor. There are 2 strategies to consider to minimize the impact of the 0.5% floor. Make larger charitable contributions in 2025 to avoid the floor when it goes into effect in 2026. And taxpayers age 70 and a half and over who have IRA accounts can make qualified charitable distributions directly from their IRA and exclude the distribution from their income. Qualified charitable distributions will not be subject to the 0.5% floor. Rather than claiming an IRC Section 170 charitable contribution itemized deduction, U.S. citizens or residents can claim a new non-refundable charitable contribution credit for qualified contributions of cash to a scholarship-granting organization. The credit is applicable to taxable years ending after December 31st, 2026. A qualified contribution is a contribution that can only be used to fund scholarships for eligible students solely within the state in which the organization is listed. Unlike the IRC Section 170 charitable contribution deduction, there is no percentage cap and no AGI floor to claim the credit. We'll be covering the OBBBA provisions in greater detail in upcoming issues of Speidel's Federal Tax Letter. For subscription information, go to speidel.com and click Publications. That's all for this week. Join us next time for another episode of Speidel's Federal Tax Minute.